I mean, when we look at the lack of breadth in the market, being active is really crucial, and that sort of seems like that shouldn't be the case, but it really is because it's what matters after that breadth returns. So when we're back in a situation where your individual choices and the quality of your choices across your portfolio do matter, we want to be making those decisions right now. So when we look at something like Nike, we are going to be interested, not necessarily because it's something that we would choose in our active positions, but because it'll help give us a little bit of insight on what else consumers are choosing. Are they choosing another brand? Are they trading down? Is everyone going to sort of suffer the same sort of drop in revenues? What is going to be the situation? And that is exactly something that explains the importance of active management.
Yeah, that Nike story tells a broader consumer story then, doesn't it? I mean, there's general sense of weakness, though, one would say. You've seen a drop-off quite considerably then in Nike. We had news out, of course, the likes then of McDonald's. You had so many retailers, even retail sales not looking as rosy as one would anticipate then. But you're still fairly bullish on the consumer, aren't you?
Yeah, so it really does also come down to what sort of approach you're taking. So when we think about the sort of tolls that all the consumers have to go through, certain things that they have to buy or ways that they have to pay, that's where we see opportunity. But then it also does depend on things like when we think about retail sales, the fact that we're facing a situation where another generation is coming into one of the most expensive parts of their lives. So when we sort of adjust for different non-discretionary things that have to be included, then we could kind of take another look at how retail sales are doing. But if we kind of just look at them nominally, then yeah, it doesn't necessarily seem great for individual brands or for certain stores that don't necessarily emphasize value, but more so emphasize just, the odd impulse spend and highly discretionary products. So it's really where value is and where there is low elasticity for income.
So in this market, then, what are you looking at? What are you then picking on? If you're seeing that weakness in those retail brands, especially, you're seeing the breadth perhaps not as widened as you'd perhaps like it because you're seeing the concentration on that top corporate stuff. Where exactly do you then go? What areas are you looking at?
Well, one of the names that we really like in the portfolio, and it is widely owned across our model portfolios and active ETFs, is MasterCard. So it's one of the top holdings in the Motley Fool 100 index. That's our TMFC ETF. And it's because they really are just a toll taker. So compared to their peers, they've gotten a little bit beat up in the last 12. And part of that is because they are just so linked directly to consumption and the different assumptions about those patterns for the rest of the year and how that might affect the Fed. But when we really think about it, they've got their cybersecurity businesses and the various other value-add services that augment their performance, as well as the fact that regardless of whether any increases in global dollar volume are real, nominal, it's all about the nominal increase, right? And so for them, the more money that is spent, the more passes through the toll. And they really are just one of very few in North America, especially, but also globally outside of Far East Asia, that are able to capitalize on those fees. So that's something we like about MasterCard because they get to maintain that position largely across the market cycle.